All right, we'll go ahead and get things started over here. I'm seeing some Pats fans too in the chat. But welcome everybody today. Our risk disclosures, alternative investments are speculative, illiquid, and investors may lose some or all of principal invested. This is not a research report or investment advice. All opinions expressed in this webinar are those of our presenters, and past performance is not indicative of future results. So welcome today to Arrive's Q4 2025 financial performance webinar. Our speakers for today are Ryan Frazier, CEO and co-founder, Cameron Wu, VP of Investments, Jake Pruchno, our head of operations, and then my name is Korin Hedlund, and I lead our investor relations team. A quick agenda, so we're all aligned. Cameron will walk through 2025 highlights, how individual properties and our fund investments performed. Jake will walk through dividends and Arrive valuation, and then Ryan will walk through what's new. And then for folks that are new to webinars, feel free to drop any and all questions in the chat. We will either answer them directly in the chat or queue up for Q&A after prepared remarks. So with that, I'd love to welcome Cameron up to the stage.
Thanks, Korin, and thank you everybody for attending today. I would love to share our operational highlights from Q4 and 2025. So quick overview of the Arrived portfolio. So it's actually close to 5 years since we started. We got our first security offerings approved in February of 2021, and it's been an exciting 5 years since then. So we've had 376 million total invested across our community with over 529 properties. Arrived as a company has raised over 40 million in funding. We've distributed 63 million back to investors in those 5 years, and we've started in the credit business, and we've already had 132 loans paid back in our private credit fund, which I'll go into more in some future slides. Here is a look at the portfolio. Now, there's a lot going on here, and we chose some different icons to illustrate the different investment strategies, so it's a little bit clearer where we deploy assets and where some of our convictions are. So you can see with the blue triangles, those are our properties, tried and true long-term rentals. You'll see that there's a large concentration in the Southeast where there's a lot of new home inventory that meets our investment thesis, as well as a lot of growth markets where you can still find really affordable homes that are new, good quality in growing metropolitan areas. With the white triangles, you can see that that's our vacation rental portfolio. So got a lot in the Southwest and the Southeast, more so springtime, fall time, and beach markets. A little bit less concentration with mountain markets in the Northeast where you might have more winter activity, but great markets all around. And then the yellow and teals are the loan portfolios. So you can see a lot of concentration on coastal cities in Florida, Washington, California, in the Northeast. So there's very distinct strategies that we employ depending on the investment class, but we'll definitely go into more of that in future slides. All right, so let's start off with single family residential, our long-term rentals. So in Q4 2025, we had an average annualized dividend yield of 4.06%, 94.7% average stabilized occupancy. And that is the average throughout the quarter. We ended Q4 at 96.5%. So we had a strong lease up, and that really has to do with how we shaped the leasing curve. That also ties into the average lease term of 16 months. Now, we typically go for a default of a long-term lease of around 2 years, but we also manage seasonality because long-term rentals is a very seasonal business. You want to have leases stacked in the late winter and early spring, because as people move out and their life changes, you want to be able to capture the stronger leasing season in the spring and the summertime. So we very intentionally land lease expirations in our ideal time frame. So as we're executing leases in Q4, we have them go for a year and then drop them off in February, March, April time to get the best leasing rates if tenants choose to move out. And similarly, as they're getting their renewals, they're looking at the market and looking at the rentals, and they see higher rents during that time. So it's worked out quite well, both from an occupancy perspective and a rental rate perspective, and we'll continue to employ that strategy. And we executed 25 leases in Q4 above forecasted rent. So strong Q4 with minimal scheduled move-outs. All of the move-outs are typically going to be early terminations or some sort of eviction as opposed to a scheduled expiration. So 2025, here's our top 5 yielding properties. They all happen to be in the Fayetteville, Arkansas market. So it's no surprise that we really like Arkansas as a state, Fayetteville as a market, and we have some other strong markets also in the Southeast and Tennessee. What's also kind of not shown here is leverage. So all 5 of these properties carry really great financing rates on them. They're all 4% or lower mortgages. So that creates a positive boost on the income ability. And one of the reasons we also are always trying to employ leverage for investors and conservative, responsible leverage, but it can these properties show how it can amplify, because if you're borrowing at 4, but maybe you're earning 6 or 7%, that actually helps boost the yield. So we have really great returns on a lot of our early Fayetteville, Arkansas properties that carry that favorable financing. Okay, turning to the single family residential fund, very similar investment thesis. In fact, I would go as far to say it's the exact same thesis, but what we've done is curated a portfolio of all of our different markets, the different investment asset profiles, and constructed this single portfolio. So, very similarly has that 4.1% return, very close to the single family residential IPOs, 95.8% average stabilized occupancy. This portfolio historically has been highly, highly occupied. I think for over a year straight, it held 100% occupancy. We introduced the SFR fund in November of 2023. So at that 2-year mark, you're starting to see turnover and expirations for those who are moving out. But we've been extremely happy with the retention in the portfolio. 95.8% is probably the lowest average quarter that it's been. So, we're expecting that it'll continue to, be a strong performer. And we have 56 rental homes in there. We're also looking at ways of adding additional yield within the single family residential fund by taking some of our credit competencies and getting a little bit of extra yield opportunistically in that front. But it's a great product. It's been performing well. And if you're looking to get a quick slice of the arrived investment thesis with long-term rentals, the SFR fund is open 24/7 and is a great way to get that exposure. All right, Seattle City Fund. So this is one of our more recent funds that was introed about springtime last year, and it's been doing great. So happy to report that it is now at 100% stabilized occupancy. So we got full lease up of all our properties by October. We've also introduced some high yielding credit within that portfolio that is helping boost the yield as those properties got stabilized. And for the future outlook, we're also looking at some interesting investments in the Seattle MSA, but I'm gonna speak to that in a later slide. But really happy with the performance of it. We issued the first dividend back in January, so pretty happy with the results so far. All right, vacation rentals. So what you see here is a lovely picture of the buyer's house. So this is the actual home used in the first 3 seasons of Stranger Things. So it's where the buyer's family lived, and we purchased it and recreated a very immersive experience that is based off all things Stranger Things. It's an awesome home with an incredible amount of detail, and it's been hugely popular. So I can go into some of those results here. But first, overall for the vacation rental segment, we had a 0.94% average annualized yield. And vacation rentals is even more of a seasonal business than long-term rentals is. So based on that map, you saw that we had more beach markets and kind of Phoenix heavy markets, a little bit less when it comes to winter high demand markets. So for Q4, it tends to be our lowest dividend yielding season for the vacation rental program. We had also transitioned a few properties back in-house to Arrived Property Management away from third-party managers. We did it extremely quickly. There was about a 2-week turnaround from taking back the listing to getting it back up after we went through all of the checks on the homes, refurnished them, restocked them, and added some nice touches to them. So really proud of the vacation rental team for that super quick turnaround. But there was downtime, and with vacation rentals, similar to restaurants on Yelp, you have to accrue a social following. You have to get enough ratings where the momentum can really pick back up. But we've brought many homes back in-house with Arrived Property Management and are very bullish about the future prospects of that operating team. So we had $689,000 of gross booking revenues. We've got 39 active bookable vacation rentals, and we're really proud of the 4.95 star average guest rating for all of our properties. It's super difficult to maintain that high rating. Any single 4-star or 3-star can really hurt the revenue generating capabilities. So our team does goes above and beyond to make sure that guests are taken care of, and that we have like strategic ways to induce high reviews to keep the revenue flowing on these vacation rentals. So here's our top 5 from 2025. A lot of representation in Arizona, but the winner is the Buyer's House. And so you can see that for 2025, we averaged a 7.4% dividend yield. What's actually really interesting about the Buyer's House is that 7.4% kind of obscures and hides how great the operating performance has been for Q4. Our last couple dividends on the Buyer's House has averaged over 12% annualized on the dividend yield, and it got a real boost from all of the announcements from season 5 Stranger Things coming out, and had a lot of social influencers and just kind of internet local celebrities that have been staying at the house and help promoting it. So it's really created a nice flywheel. We had nearly 100% occupancy in the last 2 quarters of 2025. 2026 has been extremely strong as well, as we've had the momentum from season 5 Stranger Things keeping it going. So super excited about the buyers, and but also really happy with the performance of a lot of our other markets, especially the Arizona properties. Here's a, I said we didn't have many winter properties, but we do actually have one in Angel Fire, New Mexico. So the Alta, it's a really nice ski town. So just wanted to post a review and get some shots of this beautiful house that we have in the winter, but pretty well managed as well. So let's talk about the private credit fund. So in Q4 2025, we had an average annualized yield of 8.4%. We're really proud of that fact. And when you think about some of the alternatives to where you could park cash to earn yield, you look at money market accounts, CDs, they've all been trending sub 4% at this point as the Fed funds rates have come down. So to be able to get 8.38% yield on your cash, we're really proud of those results. We've had $75 million total invested in the private credit fund as of Q4 2025, added 23 loans. We have 22,000 investors. So over 1/3 of our total investors are invested in the private credit fund. So, really appreciate that vote of confidence from the collective community. We had 28 loans paid back in Q4 2025. So a little bit of focus to wrap it up of, what does the future look like for the investment products, and what are we focused on? With single family residential properties, we're gearing up to go into leasing season, right? We are sending out all the renewals with the April and May. We're trying to get commitments for the springtime. But this is really an active time for us where we do have our leases starting to expire. We're naturally going to get some turnover, but we've also been really happy with the retention of our portfolio. When you perform the calculations of average tenancy length, we're doing better than 4 years implied average stay right now. So beating the industry right now on expected stay, which it's been about 3.4 to 3.5 years as an average among large institutional REIT players. So the leasing strategy of having those longer term leasing, biasing towards tenants who are committed to the home and are willing to sign that lease has really helped retain all of those tenants. But we do have really tactical season coming up with managing move outs, getting turns quickly, push through, and then leasing at the higher rates. So, we're happy to take, repositions at higher rates, but we do our best to keep tenants in because, a tenant who's going to stay in for the long term is your highest profit producer. Single family residential fund, similar story, less turns to manage, but we do expect that we'll have some more turnover in the springtime, but expect that portfolio will continue to be performing at a very high level. Private credit fund, we're growing our originator network. We have we like to make sure that we can pick the best loans from an originator. We don't like the idea of having a limited set of originators and being kind of forced to take whatever they're producing. We like to have a wider stable of those originators and then really select for the credit opportunities that we want. And that's how we've been able to maintain our yields in the private credit fund, as well as keep up with the investment pace, because it's been rabid as far as the investor demand for it. So keeping up with that investment is one of the biggest challenges, but we attack it by having a large stable of originators lined up so we can pick those quality assets. And the Seattle City Fund, I alluded to earlier, saying that we're also looking at different investment types. So I think what's really cool about a city fund is that the thesis is predicated on the city more so than the specific asset type. So that gives us a lot of autonomy and kind of the mandate to go and find high yielding assets and good investments just in that city. So, we have credit in there. We have long-term rentals, which have this future optionality play to divide it so we can put detached ADUs, accessory dwelling units, on it. That is, it's a land play based on some code changes that were enacted in Washington State that went into effect July of 2025. So happy that they're leased up, great land, got some good credit assets in there. And we're also looking at a multifamily project that is kind of a reposition of a really high quality asset that has been under rented, in the sense that the rents are below market rent. So as we look at underwriting these different assets and introducing them to City Fund, it's a great way to get new exposure to different asset classes, but focused around the Seattle metropolitan area. So I think that there's going to be a lot of cool evolutions within the city funds, and gives us the opportunity to find new investment types that have not typically been offered through Arrived. So, that's the wrap up and what we're focused on. And with that, I will invite Jake up to talk through some returns.
Awesome. Thank you, Cameron. So yeah, now we're going to go through how all of that kind of operational performance that we're doing on the ground translates into financial returns for investors. So as a recap, there's really two ways that you earn from your real estate investments. There is the dividends, which is the cash flow that's generated from renting out a property, or from collecting interest on all the loans in the credit fund. And then there's the appreciation, which is the change in value of the investment. Now, the dividends are considered realized returns because they are actual cash that are paid out to your Arrived account that can be reinvested or withdrawn. And the appreciation is typically considered unrealized because even though we have a change in the value of the underlying assets, you still have that capital invested and you still own those shares. It doesn't actually become realized until those funds are realized or are distributed out to you. Now, the value of the shares that you own might be higher or lower than your initial investment value, but ultimately it's an estimate until those appreciation returns become realized. Now we'll start here with the dividends. This quarter, we paid out over $3 million in dividends to investors, and we pay them out monthly. And excitingly, November was our first month where we paid out over $1 million in a single month. You can see here that the $3 million in dividends represents about a double the amount we were paying out only 18 months ago. So there's been a lot of growth, particularly in the private credit fund, that has really driven this increase in dividends being paid out through the Arrived system. And we're really excited about crossing that $1 million per month in dividend mark. Dividends are really valuable for investors because you're able to start locking in some of these returns now. So as we talk about kind of the dividend returns being realized and the appreciation returns being unrealized, the big benefit of real estate is you kind of have your cake and you get to eat it too. You get a little bit of returns that are realized every month, and then you also have exposure to that long-term appreciation. Now this chart shows the annualized rate of dividends for all of the individual properties, and it's based just off of their fourth quarter payments. It's a good snapshot of the current performance across properties, even if it doesn't fully encapsulate their full performance since inception. Now, remember that when you invest in the individual properties, you earn the dividends and appreciation for that one specific property. So you effectively have all your eggs in one basket. You may end up investing in one of these properties that crushes it and has minimal vacancy, minimal expenses, and is able to produce a higher dividend rate. Or you may end up investing in a property that has unforeseen expenses, which cause us to lower or pause dividends for that property. That potential variability of the performance of each individual property is why it's important to diversify into a number of individual property investments. Now, this is the exact same chart, but I've overlaid the dividend rate of the two flagship funds, the private credit fund and the single family residential fund. Unlike the individual properties, the fund's dividends have been really stable over time. And this is because when you invest into one of those funds, that fund already owns a bunch of different assets. And so it has some of that diversification protection built into it. The single family fund, like Cameron was talking about, has over 50 properties in it. So even if there isn't a property in that fund that's rented, it doesn't have a material impact on the overall cash flows that's generated by that fund. That's why it's been so consistent at paying about a 4% dividend every month since it launched. The private credit fund is basically the same story, since it's just a big collection of different real estate loans. It's been paying that 8% dividend consistently since it launched almost 2 years ago. Now, the dividend rate you can see is about double that of the single family fund, but remember that it doesn't have that appreciation component. So the trade-off with the private credit fund is that you're able to earn higher cash yields now, but you likely won't earn any appreciation. So now we're going to combine the dividends and appreciation to look at just the Q4 financial performance across the different asset types. And I'm going to highlight a few things on this table. So in Q4, you can see that the individual single-family properties averaged a 4% per year dividend. And that's just a simple average across all the properties that paid out of dividends last quarter. That's a mix of older properties, newer properties, and includes all the different markets. The average appreciation change for those properties was down just 0.5% over the last 3 months. Now we can see that the single-family residential fund had an annualized dividend of 4.1% in Q4, virtually the same as the individual properties. And that makes a lot of sense because our acquisition target for the single-family fund is basically the exact same as what we have for the individual properties. So it makes sense that when all those individual properties are aggregated together, it has about the same dividend yield as the fund, which is also a collection of those same types of properties. Again, at the bottom here, we see that the private credit fund had that 8% dividend. And again, while that's higher than the single family investments, keep in mind that that's pretty much all of the private credit fund's returns, since there isn't a long-term appreciation component. Whereas the single family investments over the long term will likely end up being about a half of the returns coming from dividends and half from appreciation, obviously depending on what actually happens in the macroeconomic world and in each of these specific real estate markets. Now, again, we're combining the dividends and the appreciation on this chart to take a look at the gross returns. And importantly, this chart now is not annualized. So the properties that have been owned for a longer time on the right side of the chart have had more time to appreciate and have paid out more dividends. You can see that again on the left side, those properties are hovering near 0% because they may have just launched and not started paying dividends yet, or not received their first evaluation update. You can generally see the trend here, though, that as you hold the individual properties for a longer period of time, they start to trend more upwards as they have more time to appreciate and more dividends that are paid out. Now, I said earlier that the appreciation returns come from the arrived valuation updates that you see in the portfolio, and they're all unrealized returns. And so now we'll take a quick second to just talk through the ways in which those unrealized returns actually become realized appreciation returns. The first way is when Arrived sells a property. When this happens, we distribute the sales proceeds of the property out to all the investors and wind down the LLC, signifying the end of that investment. We sold one property so far, the Centennial in the Charlotte area. And when we sold that property, investors ended up earning a 20% appreciation gain over the 3 years that they had held that investment. We may look to sell other properties later this year as they start to age into the 4 and 5 year mark since their initial IPO. Now, the second way that appreciation becomes realized is if investors sell their shares to another investor on our new secondary market. When this happens, the investor sells their shares, and that realized appreciation comes from their initial investment to whatever price a buyer was willing to pay for those shares. Then we still continue to operate that property, and then the dividends for that property in the future just go to the new owner of those shares. Our next secondary market window actually opens this Friday afternoon, and it'll run until the next Friday. The secondary market is a great opportunity to access the back catalog of Arrived properties. There's typically shares available in every property that we've launched, so you're able to invest in specific properties and markets that you may not have been able to invest in right now. The market opens on Friday afternoon, and then transactions will start matching on Monday morning. So this really gives you the opportunity to see the market data and then adjust your order pricing based on the supply and demand for each property. We'll have about half of our existing properties trade in March, and then the other half will trade, or half trade in February, and then the other half will trade next month in early March. And if you were to go to the secondary market page, there's lots of great information about how to price your buy and sell orders and how to read the market book of data. so that you can feel confident headed into that trading window to feel like you've got a good strategy in place. And with that, I'm going to bring up Ryan to start talking about what's new at Arrived.
Thanks, Jake. Thanks, Cameron. So now that we've talked a little bit about Arrived and the performance from Q4, we want to talk a little bit about what's new over the last quarter on Arrive for investors. To start, last quarter, we announced the public announcement of our secondary trading marketplace, where investors can buy and sell shares of individual rental properties on Arrived during trading weeks. As Jake mentioned, we have our next trading week coming up over the next week, and so excited to let investors participate in that. We also announced our Series B financing. We added $27 million in new venture capital to the company to really help us grow in this mission on bringing real estate investing online. So a huge thank you to all of our investors in the platform that have been supporting us all along the way, and really excited for this next phase. A few other updates to the product and to the platform. We lowered the redemption fees across all of our funds and sort of simplified how they work. We lowered the redemption fees at the start of your investment from 2% to 1%. And then redemption fees remained at 0% after 3 years. So it used to be after 5 years. Now it's after 3 years. And really just in an effort to provide investors with more convenience around liquidity as they're investing in our various and growing number of funds. We recently added tax forms to everyone's accounts, and they're now available to download. These came out around the end of January, and so you should be able to access your 1099 or relevant tax forms in your Arrived account. You just go to account settings and documents, and should have your summarized return waiting for you there. And then investors may have seen us recently talking about tax deferred exchanges. So if you're an investor that currently owns an existing property outside of Arrived and you're interested in converting that property to more passive ownership or management by Arrived and really bringing that asset online, we've started to work on a 1031 exchange program. We completed our first exchange in Q4, and we're now speaking with investors who are interested in exchanges during Q1, and really excited to chat with anyone who's looking for one of these tax deferred offerings. And this really gives investors the ability to trade out of an existing real estate asset that they own today, defer any taxes on those gains or appreciation on the asset while trading into new assets. So excited to chat with you. And with that, I think that we can move into Q&A. So I'll invite folks back up to the stage with me, and we'll go through some of the questions that people already asked throughout, but also feel free to throw additional questions through chat, and we'll get through them one by one. Thanks, everyone.
Fantastic. Ryan and Cameron, thanks so much for prepared remarks, and Jake as well. Jake will be in chat alongside our team, answering any questions there as well. A good first question with relevant events: is Arrive planning to join Trump Homes plan if the legislation banning rental home ownership goes through? What do you plan to do with the funds? Ryan, I'll kick it to you, and then Cameron, if you have commentary as well.
Yeah, this is probably a two-part, question here. One question is around the recent executive order around private equity or large institutional investors investing in single family homes. And then the second is more of a grassroots proposal that home builders are starting to put together that they've colloquially started to call Trump Homes. So we can kind of speak to both. The first around the executive order and large institutional investors investing in homes. We're still really waiting on, more of the details on what that may mean and what may pass with that. But historically, the Arrived operating model is really seen separate from large institutional investors. With Arrived, we have individual investors who are sort of co-investing together to fund these individual properties. And really, we've seen positive feedback from really everyone that we've spoken to on both sides of the aisle around supporting this model. So we feel good that the Arrive model is very unlikely to be impacted. As we kind of follow along, what it means for the market as a whole, I think we need to think about large institutional investors potentially buying less homes and what that could mean to real estate markets. I'd say the biggest kind of takeaway from the recent order is that there's not an intent to require these institutions that do own rental properties to sell the homes that they have. And I think that likely means that there shouldn't be any sort of shock to real estate home prices or real estate markets. And a lot of these large institutional investors have already been investing more in new home developments, which are called build for rent communities. And there was a specific carve out even in the executive order allowing for build for rent communities, which I think is where a lot of these large investor or large institutional investors are participating today. And you'll probably see some of them acquiring in more home builders like we saw recently. And then with the kind of Trump home grassroots effort, this is something that some of the large home builders are putting together around a sort of updated rent to own model for potential future homeowners, where large institutional investors may acquire new homes alongside home builders, allow a tenant to come in and sign a 2 or 3 year lease, and then after that 3 years, have the opportunity to potentially buy that home. And so that's something that isn't being proposed by the administration at this point. It's a proposal that home builders are putting together. Ultimately, with Arrive, we feel like we support anything that helps with expanding affordability and more flexible options for home ownership. We really think that Arrived and fractional ownership allows or has a role to play in housing affordability and more people getting home equity. We have thousands of renters who do invest and own home equity on Arrived. And the nice thing about Arrived is that if you are renting your current primary residence and you want to build home equity, but you don't want to build home equity in the home you currently live in, then Arrived is a great option to be able to invest in homes, spread your bets across multiple properties, and start getting equity that way. So that's how we think about, everything that's going on. We're watching it closely. And obviously, we'll keep investors updated if there's anything new.
Fantastic. Awesome, Ryan. Thanks so much for walking through all the details. I'm going to kick this next one to you, Cameron, from David, a 2-year investor. Thanks so much for placing your trust in Arrived. Yet they've only seen 3 vacation rental offerings in the past year or so. So Cameron, maybe we walk through current state and what we're focused on.
Yeah, definitely. So we had a larger number of offerings in 2022 and 2023. So your observation is definitely correct that we have had less new offerings. We've taken a very intentional approach to take some of the learnings that we had from the first round of buying and then be a little bit more deliberate about crafting the new vacation rental experience from the ground up with the Arrive team at every stage, sourcing the asset, the design is in-house, furnishing it was all executed internally. So we've seen that those have been the most successful rentals that we've had. But with that said, we're also continuing to internalize a lot of the operations of the existing 40 vacation rentals that we have. Our commitment is to the investors that have already, been invested, and there's new opportunities as well that I think will be, abundant in the future. But as an alternative, we also have the secondary market. So that allows individual offerings to be bought and sold directly between investors. So as new windows come up to have those assets be listed and people want to sell some shares, it's also another opportunity to access the existing 40. But once we get the portfolio even more internalized, then I think we'll have more capacity to focus on those really ground up offerings. We want to be able to deliver more vacation rentals like the buyers that have had really great income. So just being deliberate on every acquisition is what we're focused on, as well as internalizing more of the portfolio.
Fantastic. And one note here too, Jake mentioned this in prepared remarks, but we do have the secondary market windows coming up this month and next month, and vacation rentals can become available there as well. So it's another great opportunity if you're eligible to participate. Again, an existing investor in a vacation rental would need to place those shares for sale for you to purchase, but definitely stay tuned. All right, a good one from Steven. Great to see you here today. Are you looking at doing any more new city funds soon? And then Cameron, maybe we talk a little bit about performance for Seattle City Fund as well.
Yeah, so definitely looking at more city funds. We had a list of about 20 metros that we did some pretty deep analysis on and what would be the right fit. So we definitely have an inventory of markets that are high priority for us. What we're kind of researching on the Seattle City Fund side is basically what is the right construction of the portfolio that really resonates with people. So we had a couple assets in there. They've since leased up, adding some credit to get the yield and exploring new asset types through multifamily and repositioning. So we're kind of waiting to see how those investments turn out and how the investors react to it. But, so far the performance of Seattle City Fund, it was a little bit slow to lease up in the summer season. I think we started hitting a little bit of kind of like a doldrum, at least specifically in the Seattle market. But with that said, we got them all occupied by October, all cash flowing, pretty nice rents on them with that optional land play. And I think that there was actually an accessory dwelling unit question later that we can address. But it's more about crafting the right asset mix to make sure that there's enough differentiation between all of our product lines that it makes sense to invest in another city fund where you can get a little bit different exposures than, say, our individual offerings or our single family residential fund. What's that right mix? That's what we're still iterating on. But once we find what the investor community is really resonant with, then I think that will continue the deployment of additional city funds.
Fantastic. Yeah. And if there's any cities that you're interested in, feel free to share in chat. We absolutely love to hear from you. All right. A good one from Bridget in here. And I saw some comments from arrived investors in the chat. Money market rates are approximately 4%. How is arrived much better? Cameron, I'll kick this to you.
Yeah, great question. 4% on money market accounts. It's flexible. You can pull your money out quickly. So there's definitely merits to having a pocket of money for kind of short-term cash liquidity, right? So managing cash is a little bit different than having a medium-term investment and having a long-term investment. So we really see money market accounts as kind of short, flexible ways. If you need to pull out your money next month, you could. And with the 4%, I think the question might have been indexed a little bit more to the long-term rental yields. So as we were going through the single-family residential rentals, we saw dividend yields a little bit north of 4%, similar to the money market accounts. The part that's not spoken to there is the appreciation potential. And that's really kind of the core thesis of why invest in long-term residential. So you have assets that over a longer period of time will tend to appreciate. But in the meantime, you can get good income from it, at least on par with short-term rates. But you're really in it to stay for the long term, to have some income to support holding on to it and getting some yield. But you're really like playing that appreciation potential. And that's how we look at single family residential. We look for balanced dividend yields because the income has to be meaningful in the meantime. But we're investing in areas that have growth in them. And that's why we target areas that have low income tax, lower property tax, lower cost of living, because there's more potential energy in that for that to appreciate, at least from our perspective, when we're buying those new homes in those path of progress areas. So, definitely can understand how the yields maybe, seem similar, but you're really playing the appreciation on that front. When you compare it to a pure income instrument like our private credit fund, I think that the income differential becomes a lot more meaningful between the two different investment classes. So you have money markets at that 4, but then our private credit fund has been delivering over 8 since inception. So, we've been able to more than double the income yield against those short-term rates. And I think that's been very attractive for investors. But when we're looking at yields, we just have to kind of compartmentalize which part of the stack are we talking about. Pure yield with credit instruments and, debt instruments, or are we looking at investments that also have an appreciation component? Because our credit fund doesn't have the expectation of appreciation because we hold those loans until maturity. And as a lender, you're entitled to receive all your money back with interest, but there's not really that appreciation component with that particular fund. So I'm happy with the income performance on the credit fund. Long-term rentals on par with short-term rates, but really playing that appreciation and being able to stay in the game for the long run.
I think one of the things, even comparing the yields on the rental portfolios to some of the credit funds or high yield savings or money market funds, is you're really thinking about the after tax yield as well. We talk about this in our tax webinar, and investors will see this on their tax statements when they check them out here as they're filing their taxes. But one of the huge benefits of investing in rental properties is that you get to use the asset depreciation against the income, and so the vast majority, if not all, of the yield getting distributed on these rental property portfolios, whether it's an IPO or through our SFR fund or Seattle City Fund, typically is not showing up as income where you're going to have to pay an income tax. And so, when you're comparing yield, I think it's important to think about an after-tax yield as well, and the fact that on those money market funds and high yield savings accounts, you're going to be paying income tax.
Fantastic. Awesome. Thank you both for walking through it. I was trying to go quick in the chat. All right, moving back over here. Let's see, one from Bill. Are there any concerns with the private credit fund reducing its annual yield if the Fed funds rates continue to decline during the second half of the year? Cameron, I'll kick that to you. I know you briefly touched on some of that in prepared remarks.
Yeah, this is a great question. And across the credit industry, there's so many different rates and curves, so like what actually impacts what. So let's first talk the short end of the curve, the federal funds rate, kind of that overnight lending rate between banking institutions. So that really sets kind of the institutional lending rates amongst each other. And then there's premiums that are built on top of that, the further you go down kind of the value add chain of our financial plumbing system. And I would say that lowered Fed funds rates indirectly impacts credit pricing. It's not a direct impact in the sense if Fed funds rates go down, then in lockstep, the rates on those loans would also go down. The rates at the Fed funds rate is an indirect impact because it really impacts the cost of capital for those lenders. So then that changes their willingness to be able to try to get more business. How competitive do they need to be? What are their spreads between what they're earning from their borrowers and then what their cost of borrowing is? So to the extent that Fed funds rate continued to come down, then that probably encourages more capital to also be deployed because the borrowing rates start getting cheaper for those lenders. That can mean more supply of capital in the market, which over a longer period of time can depress rates. But it's not like an instant transformation in the sense that mortgage rates change all the time. Fed funds rate comes down and then that kind of impacts the whole yield curve and like the mortgage rates kind of immediately price in. It's much more of a commodity-based pricing, whereas the space that we're in, which is residential transition loans, bridge loans, ground up construction, it's really more indexed to the real estate markets and the supply and demand for projects. So while it can have that indirect effect, and you're correct to assume that lower rates puts downward pressure on the borrower rates and the yield of the private credit fund, we also have additional tools to help maintain the yield. Our private credit fund, for example, has no permanent leverage on it. It's a primarily equity-driven fund, unlevered. With that said, there's probably room for very modest amounts of leverage in that to help increase the yield, to help compensate any sort of pressure that we feel on rates. So we do have additional tools at our disposal to strategically maintain it. But these trends take a little bit longer to permeate into the market. It's not instant pricing shifts.
Fantastic. Awesome. Thanks for walking through it, Cameron. Ryan, I'm going to kick this next one to you from Josh. Is Arrive planning on setting up auto invest for dividends for preset and approved investments?
Yeah, this is something that we hear from investors a lot, that they'd like to auto invest. We don't have a planned date for when we'll allow this yet, but it's definitely something that's on our radar for adding. And there's just some regulatory requirements that we need to work through before we're able to support it. Right now, the guidance that we've received is that we would still require investors to reconfirm each time that auto investment kind of makes a trade. And so we're evaluating, with investors if they are still interested in it, given, that requirement, or whether there's additional licensing that we could receive to make it, truly more automated and let investors, really set up some criteria at the start and then let it kind of do its run on its own from there. So more to come. No current planned date, but it's definitely something that we hear from investors a lot and hope to be able to support at some point in the future.
Absolutely. Yeah, it's great feedback. I know, to echo Ryan, we've heard it a lot. We want to set it and forget it. But to date, folks can reinvest their dividends. It just is manual. So if you have dividends that are currently in your arrived cash balance, when you go to make a new investment, there's a box that's auto checked that says use arrived cash balance. So for folks that are just starting to do that, that is an option right now. But again, hopefully auto invest in the future. So great feedback. This is the best place for us to receive it as well. Good one from Paul. The pros of homes versus private credit fund is that you benefit from appreciation. Properties lost value in average last quarter. Cameron, I'll kick to you. And then Ryan, if you have commentary as well.
Yeah, no, and it's definitely a good call out, especially in the face of a quarter where we do experience some property price depreciation. So, when we think about appreciation of an asset, you look over a 20-year period, and it's about 4% annualized across across the country. If you were to look at the chart year to year, it's not a very linear chart in the least. It can go parabolic, it can go flat, it can decrease in some years. But then when you're kind of looking at it in a 20-year look back, then it very consistently has reverted back to like a 4% range. So, our take on long-term rentals is that the income helps support the timing of when you exit, right? It's very kind of moment in time, very strategic of when you have to capitalize on those returns. So, in any one quarter, totally understood that there could be a property price depreciation. In some quarters, we've experienced really significant appreciation. So, as we're looking back from the starting basis of what investors buy in, we're always monitoring, well, what has been the cumulative total return on the investment, and that's what we try to optimize for. So, definitely heard on the price depreciation this quarter. With that said, we've had pretty strong price appreciation since inception with Arrive. So feel good about our asset strategy, but the volatility can happen, and that's why we also like that balanced approach of having good enough income to really support the investment through that whole period.
Definitely. Thanks for walking through it. And Paul had some kind feedback in chat too for you, Cameron. So very much appreciated, Paul. All right, moving back over. I know we're getting close to the top of the hour. We still have a few more to get through here. A great one. Any plans to sell any more specific properties? Can you provide a list of these potential properties? I'll kick that one over to you, Cameron.
Yeah, definitely. We're approaching that 5-year mark, right, from when Arrive started and first started offering our investments, and that's about the time period when we started to evaluate whether it's the right time for selling some long-term rental properties. The answer is yes on some. The answer is no on a lot, in the sense that we think they continue to be great investments that we want to keep on the platform. So yeah, there is a short list of properties, and we'll have communications, publicly. We want to make sure that everybody has the opportunity to be apprised of those sale decisions. And then, there's also impacts on secondary market. So it's all a kind of very intentional rollout plan, but we're definitely going to, be in selling mode, as a company. Always we're looking to sell investments to deliver the returns to investors and close that full feedback loop. But it's also a matter of strategic timing too. So we're bullish that there's going to be, some tailwinds to the property market over the next couple of years. So we want to maintain the optionality of making sure we can exit at the right time for investors. But even in the present, there are properties we have our eyes on that are sale candidates.
Absolutely. Yeah, great question. All right, good one from Aaron. They would like to hear more about the addition of ADUs to existing properties. Cameron, I'll kick that one to you too.
Yeah, this is a great question, and really kind of the fundamental reason why we had chosen Seattle as our first Seattle City Fund. So as far as ADUs, just to quickly bring everybody up to speed on the idea of an accessory dwelling unit, it can occur in two ways. It can either be attached to the existing home, so think about a basement or a garage that with an independent entrance, which is attached to the home, is able to turn it into a separate kind of rental unit for more income. And then there's the detached ADU, which is quite honestly what I think we prefer here as kind of being able to provide more value when you have a more segmented piece of the parcel, your own detached unit. We think that there's a lot of value creation in that. So we haven't actually gone through converting any of our Seattle City Fund properties into a, placing that detached ADU on there. When we purchased them, we bought it with the intent to retain the option. Just by having the option and the right piece of land in of itself increases the value, because when someone sees that you can do it, then they're going to price that into the value. It's at our option on whether we want to place it. We're continuing to evaluate the economics of it. One of the reasons why we're being more deliberate about it is that we want to kind of see how the market takes to it first, right? There's also services that need to build up to execute it. So as time goes, we're going to have more architects, more firms that specialize in this. And we're also going to have more guidance from the local municipalities on the lowest friction of actually implementing it. So I'm actually on my city's planning commission, which deals with a lot of the zoning, the regulations, and like the implementation of this. And there's a lot of plans on standardizing plans to have a low friction path to actually implementing. Those are still in the works, and that's an example of one of the reasons to wait on exercising the option. But fundamentally, on the acquisition plan, you want to acquire the property where you can clearly do it. And that's what we vetted for. We looked at the regs. We looked at to make sure that there would be enough space. We personally visited all the properties to make sure that it was flat enough, that there weren't any sort of issues in being able to execute the plan. And even if when all is said and done, we don't execute implementing the ADU, very bullish that the value exists just by the change of the regulations. And that was the basis for the properties we purchased in the Seattle City Fund. So, a lot of it is optionality value, but we think that the option value increases as time goes. So that's what we're kind of biding our time on those properties.
Fantastic. Awesome. A good one in here from John. Can you give an update on Arrived itself versus the fund it manages? Ryan, I'll kick this one over to you.
Sure. Yeah. Very excited for, what we have planned for the year with Arrived. And really just continuing this mission of bringing real estate investing online for everyone to be able to participate in the asset class. We announced, with the launch of the secondary trading marketplace and really bringing more liquidity to this asset class, our recent fundraising, closing our Series B and adding 27 million in total venture capital, and from some incredible investors that are supporting the business. And so, really excited about what we have planned this year, and a lot more enhancements to hopefully the product and our mobile apps, and then, some great new investments for investors.
Absolutely. And Ryan, we had a few questions on this, and I always find it to be the biggest compliment. Folks have asked, is there any way to invest in Arrived itself?
Yeah, it's a great question. We obviously love to have, our investors on the platform also investing, in the business. And when we've done future financing rounds, we've tried to hold an allocation open for investors to be able to participate. We recently did that last year and we did it on the WeFunder platform, letting investors participate. And we'll try to, make that available as something in the future as well. We don't have any immediate plans to raise additional capital at this time. But yeah, something we've tried to make available for investors in the past, and very appreciated of, I think, around 4,000 investors that have participated in the prior campaign.
Absolutely. Yeah, we'll be sure to share. I'll drop a link to what the previous raises look like if folks are curious. But again, we'd be sure to notify if that was to open up. All right, a few more questions that we'll take prior to closing our virtual doors here. One from John. What geographic areas are you targeting over the next few years? Any that we're avoiding? Is Tennessee just too hot? Cameron, kicking it to you.
Yeah, so I think that the answer to this question is dependent upon the asset class. So with long-term rentals, we continue to have conviction in the Southeast. Generally, any state that doesn't have state income tax and has low property taxes, we're going to be bullish on. So we're always evaluating investments in there. There's parts of Florida that I would love for us to get into. I think Jacksonville's one of the a great market in Florida in terms of cost of living, and most notably, you don't get hit directly by hurricanes in Jacksonville. So the issue though in the state has been insurance. So we're monitoring the scene there to make sure that like we're not getting into properties where it's too expensive to just maintain them. But as insurance rates stabilize out, if they do, then we'd love to target more Florida. But opening up the credit side of the business has really opened up the aperture of where we can invest in as well. If you go back to the map that we had first started out with, we have coast to coast coverage now with all of our asset types. So we're investing residentially, in Washington and California, New York and Florida, but it's on the credit side. So it makes more sense for us right now to be a lender there. So I don't think that we're necessarily targeting a specific area, just like all things Tennessee or all things Arkansas. It really depends on the investment class, but on the equity side of where do we own homes, I do think that the common themes are just still infrastructure growth, economic growth, and the cost of living. If you can find the confluence of those three things, and usually you do find it in low tax states, then that's where we prioritize our equity investments for the long-term hold. And then with credit investments, you're looking for high quality, blue chip, risk mitigated, low loan to value. And that opens up the playbook, which is why we can find really good investments that we find we have a lot of conviction in the coastal areas where it doesn't make as much sense to have single family residential. The yields are a little bit too low. The risk on the equity is that the appreciation might take longer to play out. So, we have very compartmentalized strategies depending on the investment class. But as you can tell from the map, it does have us expand coast to coast. I'd say the main requirement across all is that the markets need to have enough growth and activity in them. So even if there's a really good deal in Lincoln, Nebraska, or just, somewhere that has a little bit less like growth and population, those are riskier from our perspective because we want to see very active real estate markets because that's where the growth can occur. That's where liquidity is. If you need to sell, then you don't take as large of a discount because it's a thin market. So I would say that generally we're going to be in larger population centers where there is more activity. But if it meets that criteria, I'm sure we can find both credit and equity investments that suit.
Fantastic. I was trying to get off mute and it wasn't going quick enough. Moving back over here, I think we have 3 more questions in the queue here. Cameron and Ryan, are you okay to go slightly over?
Main event. Let's do it.
Perfect. All right. We have another investor on the line, which is awesome. They have a number of single family residential properties in their arrived portfolio, but there's a significant difference between the property value change and the arrived valuation. Several properties show positive property value change, but negative arrived share valuation. They use the Odessa as an example. Can you speak to the difference and offer more context into the arrived valuation calculation? They also had additional feedback when we speak to this live. Can you reference the situation for lower negative arrived valuations for properties that have been in the portfolio for mid to long-term periods, Cameron, versus some that have just recently been added probably in the last year or so?
Yeah, this is a great question. And I would say it's one of the harder things to reconcile in people's minds of, hey, my property's going up, the share valuation has gone down. I think you've correctly identified one of the phenomenons that tends to occur more on the short term. We call it the J curve, but basically when you get an investment, you're putting money into it before you're reaping money from it, right? And that naturally will create some drag on the share price, even if the property price is going up. You're doing a rehab, you're paying out leasing commissions, there's a vacancy period. So all of those contribute to the initial dip in the share price. So that's on the short end of it. Now to address your other question about the medium term, there's properties that do have higher property appreciation than when we purchase that, yet the share price is below 10. When we calculate share price, we're looking at the equity side of the balance sheet for that particular investment. And the equity side is really just your assets minus your liabilities, right? So for some properties, they've had some operational challenges. Evictions can happen. We may be carrying a loan on a property as well. So any extended period of vacancy, it's going to drain some of that cash balance, which can drag the property share price down. And on top of that, because it's leveraged, there's less equity to begin with. So any decrease is magnified. And we like leverage as a economic return tool, but it cuts both ways, right? So to the extent that there is some value decrease, it's going to amplify it. Similarly, it's quicker to kind of dig out of the hole as more appreciation comes in, as more cash is retained. Again, it can increase faster and it can decrease faster. So my sense is that the medium term, the properties that have some of the biggest challenges in terms of share price growth are going to be ones that are levered, which would be from that older vintage that you're referencing from 2-3+ years ago. But we're optimistic that by having the right markets, the right assets, the right growth, that that's why we have a long-term view and an operating model that prioritizes getting balanced income, so we can really stay in the game to help let more of that appreciation kick in to amplify the results and kind of course correct on those properties.
Fantastic, Cameron. Thanks for walking through it. I believe there was one related to this one too. Any projection on when we can see arrived valuations on single-family residential properties go up?
Yeah, it's always tough, right? Because it's going to be a function a lot of times of the macro market. The residential valuations are very interest rate dependent, and we are optimistic that rates are starting to ease up and come down on that. So in general, we feel more bullish than bearish on the next couple of years when it comes to property price appreciation. Kind of also depends on the vintage of the property, whether there's leverage or not. So there's a whole host of factors, but generally, I would say that we think that there's tailwinds coming to the equity markets over the next couple of years, but really hard to give a precise answer given how wide of a spread of both geographies and asset vintages and leverage profiles that we have on the platform.
Fantastic. And I think there's just one more in here. Let's see. Oh, a great one on expansion. You chat a little bit about this, Cameron, but good to answer in real time. Is Arrive still staying away from multifamily?
No, not in the least. In fact, in the Seattle City Fund, we're looking at a multifamily project to invest in, to introduce into the fund. Our acquisitions team has begun the process of underwriting and finding really the right thesis overlap with our long-term rental model. And kind of the last thing I'd say about that is I wouldn't ever say that we were staying away from multifamily, but rather that there's such a large single-family residential market out there that it's really our first focus. We started this, with the idea of kind of making it affordable for people to be able to invest in a single-family residential home. It's kind of the paradigm of making a real estate investment is being a landlord of a single-family residential home. And since then, I think every couple quarters we've layered on additional investment theses onto that core model of doing a lot of great things with single-family residential. And I think we're getting to the point as a platform with large enough investment and really casting where the seeds of where we'd like to be in for single-family residential, that we now have the capacity to go and start introducing multifamily individually and into funds. So it was never intentional to stay away from multifamily. It's not part of the core thesis. We're not bearish on it. It's more like single-family residential is what we started with. It's a massive market with like $30 trillion of potential homes out there. So as we're kind of layering in different investment offerings, it's naturally evolving to the point where now we're starting to introduce multifamily.
Fantastic. Awesome. Very excited for the future. I think we cruised through all the questions today, which is exceptional. All the kind words in chat is absolutely fantastic. Ryan and Cameron, any closing remarks before we shut our virtual doors here?
I'll just say thanks everyone for joining, and Cameron and Korin and Jake and Arrive team and chat. Thanks for helping run the show and answer questions live. But just a big thank you to everyone again for joining.
Yeah, likewise. It's always great to do these quarterly webinars, and it really gives us an opportunity to reflect on how much the company has grown because of investors like you putting your faith and trust in us. And we're really continuing to develop new product features, new investment classes, all with kind of that sense of responsibility and stewardship for your investment. So it's always fun to do these and see how it evolves.
Absolutely. Well, Ryan and Cameron, Jake, thank you so much for prepared remarks, walking through the diversity of questions for our Arrive team in chat, and for all the folks that spent an hour 6 with us. We couldn't be more grateful. Fantastic questions, incredible engagement. If you have any other questions, feel free to reach out to support@arrive.com or use our chat function in the bottom right-hand corner of our platform. I'll also be sure to email out the recording to all folks as well. But have a great day and happy investing.
All right. Thank you all so much. Take care.